In our strategy, we track markets through a 5-phase cycle. We are not predicting headlines. We are sequencing risk as conditions evolve. Markets look strong on the surface, but one signal suggests the strength may be overstated, and that matters for how fast the next phase arrives. This episode reviews a video discussing Ray Dalio's latest outlook. The focus is not panic or prediction. It is how to interpret the signal correctly. The headline focused on artificial intelligence valuations. But the deeper issue was not technology. It was the measuring stick itself. Assets are priced in currency. When currency weakens, prices can rise without real growth. That distinction matters late in the cycle. Gold does not produce earnings. It reflects confidence in money. When gold leads, stress is usually building somewhere else. There are only a few periods where gold outpaces equities. Those periods tend to coincide with instability, not economic strength. Measured outside the dollar, equity performance looks different. International markets appear stronger. United States assets appear less dominant. Currency weakness inflates nominal returns. Liquidity allows markets to ignore this for a time, but it increases fragility. In our strategy, this aligns with late Phase 1 behavior. Participation continues, but sensitivity rises. This does not confirm a downturn. It raises Phase 2 probability modestly. It compresses the window if it persists. Valuations can move ahead of reality. That alone does not end a cycle. Timing depends on liquidity and confidence. The risk is not immediate losses. The risk is misreading what is driving returns. That mistake shows up later. Quick disclaimer, this is educational macro commentary. It is not financial advice. We treat nominal gains with more caution. We monitor real returns more closely. We stay disciplined with exits. This is not a crash call. It does not cancel participation. It does not override confirmation rules. Equities reflect nominal momentum. Gold reflects confidence stress. International markets reflect currency effects. This is still early, but it is no longer distant. The ladder watch zone is approaching. Hold this thought. This matters most when liquidity turns. Phase 2, risk was moderate before this signal. This nudges that probability higher. Not certain, but closer. Sustained gold leadership. Broader dollar weakness, rising sensitivity across assets. Productivity reasserts itself, currency stabilizes without stress, liquidity improves sustainably. This is about real versus nominal. Cycles eventually resolve that difference. Sequencing decides outcomes. Which signal do you think breaks first? Currency confidence or equity leadership? We do not need to be early. We just cannot afford to be late.